All right. Actually, all right, let's go full screen here. Okay. So thank you all for joining us tonight, both on the recording and live. This is the final webinar of this series called Affording the Dentist Life Part 2. And we talked about a number of different things. We talked about in the previous 3 webinars leading up to this, we talked about choosing a career that you like, why personal finance is extremely important because it dictates exactly how long you're going to work, what you're going to do, where you're going to live, and with whom you're going to work with. And then we talked about laying the foundation, about getting insurance, about disability insurance, medical insurance, and then paying back your student loans. And then the last webinar that we just had a couple months ago, we talked about budgeting and cash flow, so that you can. We talked about balancing between paying your debts off versus saving and investing. And so the last part of it is really building your wealth. And I think right now all of you are at the beginning of your careers. You're just looking to get started just to earn more, but it's not necessarily about earning more. It's now about accumulating enough so that, if you've decided that you only want to work 10, 15 years, what are you going to do when you stop working? Or, how much money are you going to have when you retire? So I'm having you guys think 2 steps ahead, simply because I know you're just looking to get your career started, but you kind of want to begin with the end in mind. And so we'll kind of go over the concepts of retirement, how much you need to retire, and then how do you get to that number, so that you can have the freedom to work as much as you want, where you want, with whom you want, and live the life that you've envisioned. So the 3 lectures were why dentists should care about personal finance, laying the foundation, debt reduction, asset protection, and financial planners. We talked about how much financial planners cost. However, they are very useful. We talked about the different types of financial planners, fee-based versus assets under management. And then we talked about budgeting and cash flow. And now we're talking about wealth building. So again, I'm going to start off every webinar by saying I'm not a financial advisor, accountant, tax lawyer, finance professional, counselor, psychologist, or therapist. I am a oral medicинist, a residency program director. I am a dentist, 20 years into my career, and kind of speaking from my experiences and from everything that I've learned over the years through the things that I've done well and the mistakes that I've made. I also have no financial interests in the items mentioned. These are my opinions based on my personal experiences. And this information is for educational and entertainment purposes only, but appreciate all of you that are here tonight. So in the end, why do we try to earn money? And money's a great asset, but we're not earning money for the sake of earning money. You can't take it with you to the grave. Money in itself doesn't buy you happiness. What does money do? It buys you time. And time is, and I've shown you this slide before by Jim Rohn, where time is the most valuable asset that you can have. It's more valuable than money. You can get more money, but you can't get more time. And I've quantified in the past how much trading, when we work, especially as dentists or any other jobs, we are trading our time for dollars. And what do we do? And the way we always aim to earn more dollars so that we can get our time back, because what does time afford us to do? To do the things that we really want to be, that we really want to do, be with the people that we want to be, live the experiences that we want to experience. And so your work, what you earn in your work, is really a means to an end. And so we talked about how it's important that you enjoy what you do in your work, but it's not the be all and end all. We're earning money to gain back our time. What's the ultimate time freedom? Well, that's retirement. So a review again, the value of your working time. If the average general dentist making $180,000 a year after taxes, I went through the math of it, takes home about roughly $10,000 monthly, works 4 days a week, 10 hours a day, so 40 hours a week, 160 hours a month. They're averaging about $63 an hour. This is after taxes. This is not their gross income. This is about $1 a minute. And so remember in the last webinar, I talked about if you're going to make that big purchase, then you are, especially if you're going to borrow money in order to do so, you are getting something now at the expense of your time. So and remember, if you borrow against something, roughly you're going to pay about 2 times that amount, whether it's your student loans, whether it's car payments, unless you aggressively pay it down, whether it's your home mortgage. And so what you do is you take that amount and you divide it by, for every dollar, that's a minute of your time working. Again, we talked about the oral and maxillofacial surgeon. They earn roughly about $440,000 a year. After taxes, it works out to about $23,000 monthly. Let's say that their hours are a little bit more, and it roughly works out to about $115 per hour. If you're doing a quick math, that's about double what a general dentist makes, $2 a minute. Last talk, we were saying that cash flow is the lifeblood. So you may have a high net worth, but your net worth is tied up in the things you own. But what keeps individuals, what keeps companies afloat is cash flow. And so when we talked about how, in terms of net worth, the person that probably had the highest net worth was the homeless individual, but they had no cash flow. And then the person with probably the most negative net worth was Michael Jackson and Donald Trump at one point. But that's because he still had cash flow, even though his net worth was in the negative when he was struggling, when the real estate market went down. Somehow he still had access to cash flow to keep things afloat and was able to turn it around. Whether you, despise him or whether you love him, those are the facts. And that's the difference between and so when last month, we wanted you to set a budget, a cash flow plan, in order that you don't get into that situation where you just have no money coming in, where the expenses outweigh the income and you just can't service that. So when we talk about retirement, we usually talk about in terms of, well, how big of a nest egg do you want? And so let's kind of break that down in terms of how that nest egg is calculated by financial planners to translate into cash flow during your future, your golden years. Here's a survey of data from 2019, Medscape of physicians looking at net worth by age. And you can see that, of course, the younger you are, there's a higher percentage of people that are younger that have lower net worths. And so the red bar is $1 million. And then, the millionaires the percentage of millionaires start to increase as they progress into their career and into their life. Now, what's interesting is that, the number of millionaires or multimillionaires, number of millionaires do peak at age 65 to 69. That's usually about traditionally when people retire. I think now the multimillionaires tend to be more in age 70 and older. But I think what's interesting is that, there's still 24% of people that are 65 and older to 69 that still aren't worth $1 million. Now, $1 million does sound like a lot. It sounds like a lofty goal, but let's take a look at what that translates to here. So I'm going to start with the poll, but before I do that, let me launch that poll. I know there's only there's only a handful of you here, but why don't you participate here? And the question is, how much do you think you personally will need to retire by the time you are in retirement age? So go ahead and kind of enter your answer here if anybody wants to share with that. All right. So I'll end the poll right here. And the results were, I think a number of, majority of you said $3 million, the majority of the handful that we have here. And then one of you did say $4 million or more. And so there is no right or wrong answer with this, but I want to give you some food for thought in determining that, determining that answer. And then you can maybe reevaluate whether that's a good answer for you or not. So let's look at living expenses in retirement. And let's assume now, in 2021 dollars, but I guess you can apply this to the current, although things in 2022 are significantly more than things in 2021 due to inflation. But let's go with these numbers here. So let's assume that you own your house outright, you don't have a mortgage, and you own your house and your home maintenance expenses are about $1,000. Let's say your miscellaneous living expenses are about $2,000 if you're living more of a frugal or lean life, or in a low cost of housing area, low cost of living area, ranging up to $6,000, or it could be more. And now, but as you get older, you tend to have more medical issues. And so let's say that there was an estimation by one database that said that the average medical expenses, and this is, paying for medical insurance in addition to Medicare, plus the actual expenses, are on average, it's $13,000 per year or $11,000 monthly. Now, I still think that number is kind of low because, a couple of nights in a hospital can easily already cost that, or one surgery can cost that. But let's just use these numbers. So when you add these all up and into monthly expenses, it rounds up to about $4,100 to $8,100 monthly conservatively. So that's in today's dollars. Now, many of you are probably just getting, early in your career, you're students. And so you're probably not looking to retire for another 30 to 35 years. You're about, maybe you're age 27. So you're about 37 years away from retirement. So, and I'll get to this a little bit later. So when we talk about financial planners, they use the 4% rule. And this was developed by financial planner William Bengen in 1994. And what he did was he took the average retirement portfolio. It's usually, like a 60% allocation to stocks, 40% to bonds. And they run all of these simulations called the Monte Carlo simulations. And what they're trying to do is, if you were to run a simulation 1,000 times, what are the odds based on different values that you're going to run out of money? Let's say that you retire at 65 and you live 30 years. So he was trying to determine what was the ideal withdrawal rate at the beginning of your retirement to such that you're not going to run out of money in 30 years, and statistically. And the number that he came up with was the 4% rule. So if you take historical returns in the stock and the bond market and factor that into somebody's nest egg, and then that person withdrew 4% of their total. So let's say you had $2 million. So 4% of that is, what is that? 80,000, I think. You withdraw 80,000 a year. And then you kind of adjust for that inflation using 2%. Then you're probably less likely to run out of money before you pass away. And so when you talk to a financial planner and they're planning for your retirement, and let's say that they're basing your retirement on a single nest egg that you've accumulated based on stocks and bonds, and they come up with that magic number. That magic number is based on this. But a lot of times financial planners will just simply say, oh, let's aim for 2 million, let's aim for 3 million, and then calculate how much you're going to earn in retirement. However, when you look at these financial planning websites, they will, or even like retirement plans and things like that, they'll have some sort of calculator, and then they'll say, okay, by the time you retire, this is how much your income is going to be, assuming that you continue to contribute this much and you get X amount of annual return in your portfolio. But they give it to you in today's dollars. So let's assume that you're age 27 now, and what we're doing is we're using all the different nest egg totals, 1 million, 2 million, 3 million, 4 million, taking what 4% of that is in today's dollars, but then utilizing inflation at a 2% annual inflation rate. Now, inflation as a frame of reference, I think last week they just revealed what inflation was between last year and this year, and it actually was 8%. I think it's probably a little bit closer to 10%, but historically, over the last 20 years, it's been 2%. Now, what does that mean? Well, that means that the cost of things go up, meaning your dollars aren't going to buy you as much in the future. So let's say that you had a $1 million nest egg, and in order to achieve that, if your portfolio achieves a 5% annual return, you have to contribute $737 monthly. And what that will generate at retirement, when you use when you pull it out, is about $3,333 monthly. If you were to pull 4% annually of that $1 million nest egg, it gives you about $40,000, which translates to $3,333 monthly. However, if you were to adjust that for, let's say, again, somebody's 27, 38 years from now, is that 38? Yeah, 38 years from now, it's only really going to be the equivalent of $1,500 monthly. Now, can you live on $1,500 monthly? Remember, we established that the average monthly expense for somebody that's retired can be up as high as $8,100 a month. So $1 million is not really going to cut it. What about $2 million? So in order to achieve $2 million, you have to put $1,474 monthly, and that will generate double that $1 million, which then translates to about $3,141, 37 years from now. The equivalent of living on $3,100. That's still not much. Maybe if you live somewhere that was really cheap and you lived very lean, maybe you can survive on that. But that's still not much. So a $2 million nest egg doesn't really get you much. This is, again, assuming that it's only 2% annual inflation. And what was inflation last year to this year? 8%. I don't even think that inflation is going to be 2% going forward. I think it's going to be closer to 4% on an annual basis going forward. $3 million, using the same calculations, you'll get about, you have to contribute $2,000 a month. That will give you about $10,000 monthly income, which really only adjusts to about $4,700 after you adjust for inflation 38 years from now. Lastly, $4 million, that you will have to contribute close to $3,000 a month, for, up until retirement, in order to get a $13,000 monthly income, which translates in the future to only about the equivalent of $6,200. So you're roughly there now with a $4 million nest egg. Now, what I didn't factor in was Social Security. And, taking the example for me, where they were projecting that I would get $48,000 if Social Security is still around. I don't think they're going to get rid of it. I don't know if they're going to pay out the same amounts that they're paying out now in the future by the time I retire, let alone by the time you retire. But what they were estimating was that they'll pay me out $48,000 a year. which would give you an additional $4,000 a month, but which really only translates to less than half of that, an extra $1,885 a month, assuming that you're age 27 now. So the point being is that when you factor in inflation, your money in the future is not going to really buy you as much. And you have to plan for your retirement to adjust for that. So there are savings goals calculators that you can use. This is the one that's on the US government website, where you can put in what your savings goal. So some of you put 4 million, some of you put 3 million. And then you could put what your initial investment is, how much time you have for it to grow, what the estimated interest rate is. 5% is I think it's pretty optimistic if your portfolio can generate 5% a year. And then, that it's compounded annually. And then it will kind of give you how much you have to contribute and in order to achieve that goal. Now, I also built in the tool, a calculator that does this for you. And I think what I might do at this point is to stop the screen share. And I have an example, and then I'll screen share that calculator here just to show you how it works. Okay. So here it is. This is on the bottom of your budget. And so I know I made this available to all of you last talk, but again, I'll on the follow-up email to this, I'll send it out. So I've got a couple calculators, one for retirement savings, one for debt pay down, one for calculating your mortgage. So the retirement savings one I'm going to use. So let's assume that you're age 27, you're starting with nothing. And you have, this factors in what your IRA contributions are in here. So I'm going to say 0 here just to give you a clean amount. Hold on a second here. It's not, let me see if I can move my Zoom control bars in my way here. So enable editing here. Okay. Let's open that back up again. Okay. So let me change this to 0. This is assuming if you're taking an amount of salary, amount of contributions for your salary. So let's say you're doing a monthly contribution of, let's say about $3,000. And your retirement balance is 0 and you're getting a 5% return, then you'll end up with about $4 million at retirement. Now, $3,000 monthly contribution is a lot, but I'm just using this as an example. Using the 4% rule, that will translate to about $13,571 monthly. But then if you were to adjust it for at age 65 based on 2% annual inflation, which again I think is a low number, it would give you about just shy of about $8,000, living, the equivalent of $8,000 in today's dollars. So this is a great tool. Let's say that you contributed $2,200 a month. This gives you about just shy of $3 million, which translates to just shy of $10,000 a month, which 38 years from now really would be the equivalent of $5,800 a month. So in terms of determining your retirement, it's really kind of determining what's your monthly budget going to be. And I know that's hard to determine, but what's the type of monthly budget that you want to have now, kind of translate that into dollars in the future, and then kind of get that that magic number for retirement. Now that's assuming that all you're doing is just kind of building up a nest egg, which is what most people do, is they're kind of just, I'm going to save this much, and once I get to that number, I'm going to retire, and then I'm going to live off that amount. But now if you've got other forms of passive income coming in, then maybe that number doesn't have to be as large. Maybe if you invest, if you own real estate that generates cash flow or income, you may not necessarily have to build a nest egg as big. But I'm going to talk about, sort of touch upon those things afterwards. So I'm going to stop sharing that, and I'm going to go back to our PowerPoint here. Okay. So in terms of interest rates, we have the rule of 72. So what it does is it takes, basically, I think I brought this up when we were calculating your debt, how long your debt's going to double, but based on certain interest rates. Here it's how much time. Now this is assuming that you're not adding money to that balance. So let's say you had $100,000, and then you had 72 divided by, let's say, a 7.2% interest rate. That tells you that $100,000 will become $200,000 in 7 years. And so so roughly it's just about taking 70 divided by the amount. They'll tell you how long it will take to double based on the interest rate. So we talked about, now, how do we get higher returns? Well, you got to invest them in something. And so then the last part of this talk, I'm going to go over the second part of this talk, I'm going to go over the different investment vehicles from the beginning. What do they mean? And then the last part, I'm going to talk about where you can invest them in and the different types of vehicles you can invest them in, the different types of retirement accounts. And so these are the ways that you can build your wealth. It's stocks, bonds, cash. You can stockpile cash, commodities, real estate, speculative investments like crypto, or in your business, or investing in businesses. So that would include your dental practice if you're going to start one, or that could include investing in startups, angel investing. And I'm just going to touch upon all of these different things. Now, traditionally, financial planners will probably set you in a combination of stocks, bonds, and your practice if you're a dental practice owner, and cash. But I'm going to talk to you about the role of some of these other assets. So stock is, it's basically a partial ownership of a company. And we think of stocks as these ticker symbols that we see on CNBC that are scrolling across the bottom of your screen, and people are just kind of trading them, buying them and selling them, and buying them and selling them, hoping that they can buy it low and sell it high, or if they're doing other things, trading options, that they're betting on the direction that it's going to go. But what are we trading? You're actually trading a small piece of an ownership in a company. And so a company, when they need to raise capital to operate or to expand, they sell shares of the company. They use the money, that the proceeds of selling those shares, in order to reinvest in the company so that they can grow or operate. So we know the publicly traded stocks, those are the ones that you see on CNBC, and they're bought and sold predominantly on stock exchanges, usually through these platforms. But you can also have private sales as well. So some of these companies that are not publicly traded, you can sell shares of the company. Those are also stocks. So anything that's a share of something is called a security. Now, where do you get the value from? I talked about how we know people. I know I'm guilty of it, of buying and selling stocks, thinking, okay, I'll buy today, maybe it'll go up in 5 months and I can sell it. Or you got day traders that are buying by the second. They're buying and then within a few seconds selling later, just kind of betting on the direction of that stock. And so you're basically banking on the increase in value. That's what most people are banking on. They buy it low, they sell it high. However, businesses, they generate income. And the ones that are a little more established will decide that they want to share the proceeds of that income with their shareholders. And what do they do? What are those? Those are dividends. So it's like a company. If the company makes a certain profit, they want to dispense some of that profit to the owners, and those are the dividends. So you generally see those in your more established companies, your more mature companies, not the ones that are growing. Like the ones that are growing, like these tech stocks, like your Teslas and stuff, they're actually not making money. Because they're growing. So they generally don't want to pay their profits out, well, they're not making any profits. They really have nothing to pay to their shareholders. And so, but why are those the ones that people like to pour their money in? Well, they're thinking, well, it's going to be worth more in the future because they've got this wonderful product and they hope that it's, that they're going to be profitable in the future and that their stock price is going to go up. There are two main types of stock, common and preferred. The ones that you typically buy are the common stocks. You have voting rights, but the preferred stocks are generally a different class of stock where they are kind of, if the, they are more, they have first dibs on the payout of any profits, or if the company were to go under, other than the people that they owe debt to, like their lenders that, like banks, if they owe, the preferred stockholders will get, paid first before the common stockholders. But the main thing is that if you were to buy stocks, most of the ones that you're buying on the stock exchange are common stocks. And those are most of the ones that anybody who's invested in something like in a retirement account or in a mutual fund, that's what their stocks are in common stocks. So the S&P 500, which is a composite of, it's actually not 500. I think it's like 550 companies. If you were to invest in a basket representative of the makeup of the S&P 500 and you had it for 20 years, this graph tells you what your average annual return is at that point in time. So meaning, I'll use the example, January of 2000, if you had your money in the S&P 500 from the year 1980, 1980 to the year 2000, 20 years, you would have averaged a 14% return. Now, why was it so high in the year 2000, but then afterwards, like in the year 2003, it dropped down to 10%? Or even better yet, what about in January 09? If you were invested in, if you had money from January of 1989 and had it in the S&P 500, it would only give you about 5% compared to the person that, probably, that's the time that had 20 years preceding the year 2000. Why did the average annual return drop so much? Well, it's because in the year 2000, there was the tech bubble where a lot of the technology stocks, these growth stocks, like the ones that today would be Tesla, back then it was anything that said .com. They thought the internet was the rage. So a lot of these stocks were artificially inflated way more than, none of them were making money. And the stock market crashed after the year 2000. And, like 50% drop down in value. Well, all of a sudden, your portfolio dropped 50%, in the S&P 500. And so it significantly dropped your returns, or, over your average return over the past 20 years. Now, it didn't drop 50%, but what it did was it dropped, your returns from what would have been 15% to 9% annually. It's just because your portfolio just really, really decreased in value. Now, we had the global financial crisis in 2008. Again, another 50+% drop. So let's say you were about to retire then, then your portfolio dropped significantly if you had a significant exposure to the S&P 500. Well, you went from having an 8% return to now like a 4.5% return annually. So that's why we have these fluctuations. And so many of you are going to be investing over a 20 to 30 year time frame, but you can see that big market drops can affect what your average annual return would be over that time span. So stocks are more volatile. So most financial planners will not put people's money into 100% stocks. They put it into another asset, which is bonds. Well, whereas stocks are part ownership of the company, bonds are actually, you're actually a lender of to a company. And so these are units of debt issued and securitized as tradable assets. Now, bonds don't fluctuate as heavily as stocks. You're not, and but they still do rise and fall in value. And so basically you are lending your money to a company, the government, whatever, some sort of entity, and you're being paid an interest. You're being paid in order to lend them that money. And so it's this now, some of the mortgages that that you have are actually issued as bonds to people. And so the amount that you're paid is determined based on the interest rates. So right now we're at historically low interest rates. So whatever bonds are paying out are very low. And the interest rates are based on the federal funds rate, which is determined by the Federal Reserve or the central bank of the United States, or in other countries, there are central banks. And it's the amount banks have to pay the Federal Reserve to borrow money from them. And then what they'll do is if it's a low amount for them to borrow from the central bank, then they're going to charge a lower amount to lend the money out to you. So that determines also mortgage rates. But it also determines that if you're the one that's lending the money, how much you're going to get paid. Now, if prices are inversely correlated with interest rates. So when rates go up, bond prices fall and vice versa. Now, let me kind of back up and tell you how that works. So let's say you had a bond, you've loaned money to a company, and you're earning 7% annually on that, just for lending the money to that company. Let's say that interest rates fall, and let's say that interest rates fall to 3%. And now bonds are, would you rather have a bond that's paying you 7%, or would you have a bond that's paying you 3%? You want the one that's paying 7%. And so if you're the one that happens to be still paying 7%, that one becomes more valuable. That's why the price of that one goes up. So let's say you're holding a bond that pays you 3%, and all of a sudden somebody can go get a bond that pays them 5%. All of a sudden, the one that you're holding that pays you 3% is less valuable. And so that's how the prices of the actual bonds themselves can rise and fall. But again, it's not as volatile as stocks. And so financial planners like to include bonds, one, because it pays an income, although right now at current interest rates, it's very, very low. So you're not going to get much of an income from it. And number two, it's less volatile. So your portfolio is not going to jump up and down as much as it would if you just had nothing but stocks there. Now, bonds, in terms of what they pay, they'll pay more. The more risky of a borrower you are, the more they're going to pay. Now, the least riskiest borrower is the US government. And so when you buy bonds, you're actually lending money. When you buy US Treasury bonds, you're actually loaning money to the US government, because they're probably the least likely to default on that loan. But companies that you lend money to, that you buy bonds for, AKA lending money to, they can range. It's kind of like your individual credit score. So some people with high credit scores, the individual that has a high credit score, like in the 800s, for instance, a company would have a AAA bond rating. And whereas companies that are a little more risky, so that'd be like the individual, going back to the analogy of an individual that has a low credit score because they've had a history of not paying their bills on time, they don't earn as much, all that sort of things. Companies are also rated that way, and they have lower bond ratings like B and C. Those companies, now you'll tend to have a higher interest rate payment for holding that bond because they're more risky. Now, those bonds are called junk bonds. Those ones that are on the lower rated bonds are called are junk bonds. It's not because they're junk, it's just because they have lower ratings. So remember how I told you that if the baby boomers, my parents, they had their money in stocks and bonds. Well, since the 1980s, there was a time where bond interest rates were 10 and above, or just interest rates in general. And the same goes for if you were to buy a house. I know the first house that I lived in, I think the mortgage interest rate was really high. And that's because the Fed funds rate and bond rates were really high back then. And over the last 40 years, they have done nothing overall but go down, to the point where last year they were almost at zero. So in other words, you lend money to the government, you are actually barely getting any interest payments out on that. Now, remember how I told you that bonds values go up as interest rates go down. So if you had bonds in your portfolio over the last 40 years as a baby boomer, you did really, really well. The value of those bonds went up, even though their payouts have gone down. What about mutual funds? So this is now all of you, at least that have an employer, or actually most of you that have some sort of retirement plan, have your money put in a mutual fund. Well, what's a mutual fund? It's really a fund, a portfolio of stocks, bonds, and other securities. And so what they do is, while you can't own, probably you can't afford to buy, the average person can't afford to buy shares of all 500 companies in the S&P 500, you can buy a bond that represents that. That doesn't require, that allocation of buying all the individual stocks. So it gives you the advantage of having a nice exposure and access to diversified, professionally managed portfolios at a low price. And they can be divided in different types of categories. You've got ones that are called index funds that mirror what's in the various index. You have the ones that are retirement funds that try to allocate your portfolio based on level of risk based on your age. And I'll go a little bit more into that in the slides ahead. Now, it does cost, there is somebody called a fund manager that manages this thing. And it costs money for them to maintain these funds. And so whenever you buy a mutual fund, whether it's inside your retirement account or not, what you want to look for is what are those annual fees? And those annual fees are called expense ratios. And so that's what they're going to do, is that they'll give it to you in a percentage. And I'll show you that in a couple of the slides going ahead. Excuse me. The majority of money in employer-sponsored retirement funds go into mutual funds. So if you look at, Atrium Health, for instance, where I work, the standard allocation by default is into one of those retirement target date funds based on your age and your year of retirement. And I'll go over what those are. So this is what if you were to look at the Atrium Health retirement plan, these are the mutual funds that they offer. And so you have these JP Morgan Smart Retirement Funds. And the later the year, the more, this kind of is roughly when do you want to retire? And so these are a baskets of a combination of bonds and stocks. And there's a general rule of thumb is as you get closer to retirement, you want to have more bonds and less stocks because you don't want it to fluctuate as much. And then the further away you are from retirement, you have more stocks and less bonds. And so that's how they've positioned these accordingly. But there are a number of different other mutual funds, at least in our example, American funds that's investing in companies in Europe and in the Pacific, ones that are investing in smaller companies, ones that are investing in international stocks. Developed markets are also international stocks. Small cap are smaller companies, middle cap are middle-sized companies based on how much they're worth. Here's a good one, a total stock market. It just basically you're buying a basket of the entire US stock market there. And then you got some bond funds, and then you got ones that are pretty much cash, money market funds here. So these are the choices. You can choose how to allocate it. At least for us, they take your age and then they'll put you in one of these by default. But you can always allocate it yourself and change it, which I do. Now, there are a number of different types of mutual funds. There are open-ended funds and there are closed-ended funds. So the closed-ended funds involved, you only have, let's say that this fund is only going to have 50 million. So we can only have X number of people investing up to $50 million. Once we have $50 million, then we're not going to accept any further investors. That's what a closed-ended fund is. Now, most of the ones that you're seeing, like the ones I just showed you, are open-ended funds. They're going to continually add or destroy shares based on number of shareholders that buy into it. So that's what you want to know. The other part is that there are load funds and there are no load funds. Now, if you've got a financial advisor that works that probably isn't charging you anything up front, they're probably making money off of putting your money into a loaded fund. And what they do is they, let's say, and I only realized this only just a few years ago with our financial advisor who we have in Canada. I'm like, oh, this is such a nice guy. He's never charged us anything. Well, it's because every time he'll, once or twice a year, he'll say, or every other year, he'll say, oh, I think I'm going to move your money from this fund to this fund. And whenever he does that, he actually takes a commission every time he buys that new fund, which is a percentage of our money. And so that's what you want to look out for is the fund loaded or not loaded that your financial advisor is going to put you in. The other thing with mutual funds is they're not very tax efficient. So they are a portfolio of stocks and they tend to buy and sell the stocks. And whenever you let's say you sold the stock and you made a profit on it, you get what we call a capital gain. Well, that capital gain is taxed. Well, if you're a mutual fund holder, and even though let's say the entire value of the fund went, let's say it went down over the year, but if they've got stocks inside that fund that they sold and for a capital gain, you're actually going to get taxed your share of that capital gain. So mutual funds, if you were to put it in a non-retirement account, can be subject to tax. So you can actually conceivably have a mutual fund that goes down in value. You still own it, but then you'll actually have to pay taxes on your portion of that based on the capital gains inside of that mutual fund. So they're not very efficient. And that's why they've kind of fallen out of favor in a number of ways. Now, this picture is a picture of Jack Bogle. He is the founder of Vanguard, probably one of the largest mutual fund companies in the world. And he revolutionized investing by introducing the concept of index funds. And so prior to that, you put your money into a mutual fund and there's a manager that would try to put together a portfolio of stocks and bonds that they think were going to do really well. But what Jack Bogle did was he said, let's create a fund that just simply mirrors the composition of the stock market or whatever index. And so just like that total stock market fund, all it does is just mimic that. And so you're not really trying to just actively try to outdo the market. You're actually just copying the market and representing the market. And why is that? Well, he found that most people, even the professionals, these are people that have, the CFA designations. They've gone through all the schooling, they're professionals, they research companies. The people that manage these portfolios in general don't do better than the market itself. They may for a short period of time, but over the long haul, they usually don't do any better. So when you compare an active mutual fund, some manager trying to do better than the market than just buying a mutual fund that represents that particular index, you can see in almost all cases here, the index, with the exception of Euro stocks and real estate, and the bonds, when you're talking about stocks, the indexes do better than the ones that were the regular mutual funds that were managed by portfolio managers. Now, the portfolio managers will charge a fee, whereas the index funds, because there is not much research involved, they charge very little to no fees. And so that active mutual fund manager has to outdo the stock market by more than the fee that they're charging in order for it to be worth it. And the majority of actively managed funds don't do better than the stock market, than the market itself. So you're better putting your money into index funds. So when we're looking at the expense ratios, so you got that retirement fund, that JP Morgan retirement fund, they charge a 0.47% annually expense ratio. So they shave off that much. Now, when you compare, let's say, an index fund that just represents the stock market that charges a 0.02% versus an actively managed fund that charges 0.63%, I have a scenario, let's say that you put $2,000, let's say we had a 6% rate of return. Let's say both of these give you a 6% rate of return, and then you subtract the expense ratio, and this gives you what your total rate of return is. So in this case, minus the 0.02, it's a 5.98%. In the case of 0.63, it's a 5.37%. So if they overall perform the same, but just based on the fees alone, you're going to have a difference in about more than $300,000 when you retire. So, and that makes a big difference, having an extra $300,000. And that's why putting your money in an index fund is probably the most efficient way to do it. Now, let's say that you want, you don't want to actively manage your stock and bond allocation and you want it done for you. So these smart retirement funds are pretty good, but you are paying a bit of a fee for it. And 0.47% using this example. And so this would give you a return of about 1.7 million, assuming that this generated the same 6% return as the total stock market fund. Now, generally, if there's more bonds, it's going to probably generate a lower return, but I'm just using this as a basis of comparison. And so it's about a $200,000 difference if you were to put it into an index fund versus one of these smart retirement funds. But I think it's, I'll kind of show you when we talk about asset allocation. It's still a very good way to put your money in, especially if you're not going to use a financial advisor. And I think there's a lot of reasons why you don't necessarily have to. I kind of have to use one. If you just want, you can put it into a managed portfolio that will do it for you at a very low cost. So going back to John Bogle or Jack Bogle, of the 335 mutual funds that were since 1970, most of them have gone out of business, and only 24 have outpaced the market by 1%. That's terrible odds when you're talking in the long term. So putting your money in a mutual fund versus putting your money in an index fund that charges you less, the odds are you're going to do better in an index fund. And so Warren Buffett, even himself, said the best way to invest, unless you are like him, is to put your money in a low-cost index fund. Now, everybody tries to imitate Warren Buffett, but he's got a unique advantage, and the average person, even the professionals, just can't imitate what he does. Warren Buffett has generated about a 20-something% return in his company over the last 50 years, which is crazy. But he buys individual businesses, knows the businesses intimately, knows which businesses are going to do well, and allocates his money according to that. We're not Warren Buffett. You're better off just putting it in something that mimics the market. At least your stock allocation into that. So we talked about mutual funds, how tax inefficient they are, and how they have load and non-load. So a nice alternative to that is something called an exchange traded fund, and it's just like a mutual fund. They could be a basket of securities, stocks, bonds, or other things, but they don't have, they're much lower in cost. There's no lower expense ratios. They still have expense ratios, and they also don't charge they're not subject to tax based on capital gains, assuming that you have it in a taxable account. And you can freely exchange them, buy and sell them throughout the day, as long as the stock exchange is open. Again, no commissions, lower expense ratios, and no taxation, except for on the capital gains when you sell it. So if you bought an exchange traded fund that was $10 and then you sold it at $20 per share, you're going to pay taxes on a capital gains tax on the difference between that, that $10 and $20 that you've earned, assuming that it's not in a retirement account. So real estate. I can talk for hours about real estate because, I did mention before, I have a good portion of my portfolio in real estate, and we own a real estate investing business also. So the different ways that you can invest in real estate is, we all know what we see in HGTV, where they'll, everybody knows, well, you buy your own house, and you build equity on that. I talked about the difference between owning a house versus renting, how much that's going to cost. But it is a good way of building equity, or forced savings, so to speak. And then you can buy investment properties. So you can buy a short-term rental, or you can buy a duplex or a quadplex and rent it out to tenants. Some people, they'll flip it. That's what you see on HGTV. They'll buy buy a house, fix it up, and then sell it immediately for more than what they bought it for, and hopefully make a profit off of it. You can also, but if dealing with tenants, toilets, termites, and taxes is not your cup of tea, getting that 2 o'clock phone call from a tenant that their air conditioning's broken down, then you can be a passive owner. There are companies that do turnkey ownership where you buy the property, but they'll manage it for you for a small fee. And so you don't have to deal with tenants individually. Syndications. So I manage a syndication company. Where what a syndication is a large pool of investors pool their money in order to buy a larger property. And so, as an example, we just closed on a 202 unit apartment complex in Houston. And what we did was we pooled money from a number of investors in order to fund the down payment of this $28 million apartment building. Now, me by myself can't buy it, but if I pool a bunch of investors, we can do that. That's a syndication. You can invest in that also. Real estate funds. There are some funds where they, in a group, purchase either one or a number of a portfolio of big properties, kind of similar to a syndication also. And crowdfunding is similar to syndications and real estate funds, in which you do this through some sort of platform on the internet, and you can allocate usually a smaller amount. Now, syndications typically would have $25,000 to $100,000 minimum investment. Some are as high as $200,000. Whereas crowdfunding, you can probably invest in a real estate, a share in a building for as low as $1,000. So that's what crowdfunding is. Now, real estate investment trusts, those are publicly traded on the stock exchanges. And so those are they're kind of like stocks that own a portfolio of different types of real estate. And so, and now those are, you buy and sell them on the stock exchange just like you would any other stock. And so they're subject to more volatility, going up and down than the other ones, where the other ones, you buy it once until you hold it for 3 years until the fund or the asset that you're buying is resold for a profit that you share in the profits of. Now, me personally, I participate in all of these things with the exception of turnkey ownership. So we own investment property, we run a syndication company, we're passive investors, we're also the operators of the syndication. I've got money in crowdfunding, and I do have shares in real estate investment trusts as part of our portfolio. There are other alternative investments. So there's angel investing. So we watch Shark Tank, where that's a good example of angel investing in a way, where you got somebody that is pitching their business and they're trying to sell partial ownership to the sharks and they'll share in the profits. There are crowdfunding platforms where you can invest in angel investing, startup companies. So let's say you were somebody that angel invested in Airbnb or Facebook right when it was starting. You can make a lot of money doing that. Now, the risk is much higher because there's a higher rate of failure of these. So, but the potential returns are very, very high in these things. There's also private debt. Now, what private debt, remember we talked about bonds, where you're doing it more at a company level or corporate level or a government level. There are vehicles where you can pool your money to lend to somebody. And so an example there are private debt where you can buy a note. If you're the one that buys, it's a bond if you buy it for corporations or the government. It's a note if you're doing it more for smaller groups. You own the note on that debt. Again, you're lending the money to somebody's paying you a certain percentage amount, and then you hope that they're not going to default on that, and then you get your money back, plus your interest that you earn on that. Commodities, we talk about investing in gold, silver, oil, natural, there's, you can trade other commodities like food. So there's up to now, there's still a pork belly exchange, corn exchange. That's another way and now there are ETFs where you can put it into commodities, which is how I've invested into commodities is by putting it into an exchange traded fund for that. Cryptocurrency. Here's a picture of Bitcoin. Some say that's the future of currency, but it is very, very volatile. Bitcoin, I think a couple of years ago, I bought some Bitcoin when it was $8,000. It rose all the way to $60,000. Now it's back down to $20,000. But there's some. I actually believe in the long-term viability of it, and so I have a portion of my portfolio in it also. And then there's collectibles. You'll see actually some crowdfunding sites where you can actually own a share of a famous painting, I think that painting over here was by an artist called Rothko, and it sold for $171 million. So like a red square with two squares inside of it. Whatever the value assigned to it, maybe that's a way that you can also store value in your portfolio, or you can even participate in owning a partial share of it. So when we talk about alternative investments and crowdfunding, Fundrise is probably the more well-known real estate crowdfunding sites. I'm invested in Yield Street. So I invested in a crowdfunding real estate. I think it was like a Houston apartment building through Yield Street. I've also invested in a note where you're lending money to a shipbuilder, in turn for a interest. Now I got to tell you, I lost money in one of those. And then here's a list of a number of different ways you can invest in alternative investment. You can invest in farmland. You can invest in Masterworks is the one where you can invest in art. Grayscale is the one where you can invest in crypto. Equity Multiple is one you can invest in real estate. Bitwise is in crypto. AngelList is if you want to invest in startup companies. So there's a lot of different ways you can invest your money other than stocks and bonds that are just traditionally offered by financial advisors and 401ks in order to help build your wealth. I just wanted to introduce you to these concepts. Now, what you want to do is be diversified. Financial advisor said the most important thing is your asset allocation. And the idea is have more of your money. Now, if you in the least risky assets and have less of your money in the more risky assets. So it's not wise to take 100% of your money and put it into Bitcoin. Now, if you had 1 or 2% of it, maybe that's a good idea. Now, you also can't, the reason why you don't put it in the safest is that usually safe things don't really pay you more. And so you want to have a mix of more risky assets and some safe assets, because if you don't have the risky assets, then it's not going to grow. If you have just a bunch of, if your money's just sitting there in cash, which is the safest thing, or in government treasury bonds, it's just not going to grow. So you got to have something in some more risky assets. So equities, fixed income, and cash have different levels of risk and return, so will behave differently over time. And it is the most important factor in determining your outcome. So what's one way that you can have your assets allocated for you? Well, one is you can hire a financial advisor, but I talked to you about how costly that could be. Now, when you're starting your career, your portfolio is probably zero, but let's say your portfolio is $1 million down the road, your financial advisor is going to collect $10,000 of that every year. And that's going to really take away your returns. So another way of doing it is just putting it in a retirement fund that does asset allocation, at least in stocks and bonds for you. And so here, one for 2055, they put it in US, when they say US equities, they are US stocks. So 48% of it's in US stocks, 35% of it is in international stocks. So the combination of that is actually pretty high. It's like more than 90% of it is in stocks, whereas then the rest is in bonds and some of it is in cash. And so then they adjust that accordingly. And then as you get closer to 2055, they're probably going to put more into this fixed income and less into the stocks. And they'll do that for you for a 0.47% annual fee. When you look at asset allocation over the years, historical returns over 90 years almost 100 years. 100% bonds will give you about a 6.1 average annual return. If you were to add 30% stocks, it goes up a percentage and a half point. It goes up even higher if you had more stocks than bonds. And then if you were 100% stocks, the average annual return again is about 10% over the long term. But remember how I showed you how it can fluctuate, and you can have a year where stocks will drop 50% like it did in the year 2000 and the year 2008. And so that's why you don't necessarily want to put your money into 100% stocks, even though over the 100 years return, it gives you the best annual return. And so that's the reason why you want to kind of diversify it across different asset classes. So I just updated this for you folks to as to show you what exactly I do this quarterly. I look at everything that I have and I kind of break it down into different assets and in terms of different things. And so I'm actually invested only 21% in stocks and a small amount in bonds, but I also have some in gold, some in commodities, some in real estate investment trusts. I'm carrying a high percentage of cash right now because we're looking to deploy it into a number of different assets. We want to grow our real estate portfolio. I do have some money in crypto. And again, alternative investments also. That can include real estate that we own, the value of real estate that we own, and also some of these crowdfunding sites that I invested in. So this is just an example of how I have ours set up. This is by no means, do not mimic this. This is what we're doing because again, our situation is a little bit different at this stage in our careers and in our lives. So then, some people are saying, well, why don't you put your money into a particular stock? You can be a millionaire. And so what this graph shows is Amazon stock between its inception in the early 2000 to early 2022. And yeah, so if you put $1 in, it can expand into $3,200. Great. Now, the question is, how many people actually have owned Amazon stock from day one? Probably only Jeff Bezos, because on the way to getting up to this $3,200 price range, back in the year 2000, it dropped pretty much 90%, almost to zero. And then it went back up, went back up, went back up. And then 2008, and then it dropped another 60% on the way back up to where it is today. Now, would you be able to sit there and stomach a 90% drop? Probably not. People think that the road to riches is I can find the one magic stock that's going to go up 3,000%. That's just not going to work. So, but then I go on these sites and there's this one group, it's called the Dental Investment Group on Facebook. And you'll see discussions like this of individuals talking about individual stocks. And so here's one where somebody bought Roku and they said they bought it when it was $400 and the company looked great. And then it dropped down to 300. And so now they're asking the group, should they buy more or should they just wait and sell? Or should they just sell now and take the losses? And, I'm guilty of doing this. I might have told you the story back of when I was in dental school. We invested a significant amount of money into these penny stocks that ended up going to zero. And so if you think you're going to make your riches basically doing this, it's akin to gambling. Now, am I saying don't do this at all? No, what you do is if you really want to do this, maybe allocate a small portion of your portfolio into doing these sort of individual activities, trading individual stocks. Now, we heard about, before last year when the Wall Street Bets group forced the price of stock through their manipulations, forced the price of a company that looked like it was on its way out, GameStop, into record highs. And all these people were trading on these platforms like Robinhood that are really easy to buy and sell stocks. And they were using options where in some of them they were borrowing money that they didn't have for the right. It's kind of like taking a mortgage on a house for the right to buy a bunch of to own a bunch of shares in that stock. Well, let's say what you're putting your money in is 10% of the actual total amount of stock you're in. If that stock went down a bunch, you're also going to you're also liable to owe 10 times that amount. And so this happened to one guy who was investing. They basically, when GameStop stock dropped after that big rise, their allocation into it, $16,000, they were liable for $730,000 that they had to pay back based on their investing on margin. And so this guy was in his 20s. He ended up committing suicide when he found out that he owed $730,000 from these types of activities. So when you're talking about stock picking, individual US stocks, the market annualized returns of 14% per year. 9 out of 10 years, the whole market was positive for the year. Only 42% of individual stocks are positive for the entire 10-year period. 36% are negative for the 10-year period, and 22% of those companies are gone. So if you were to pick individual stocks, the odds are against you for beating the market. And then 4 out of 5 stocks trailed their own benchmark in their industry. So lastly, I want to spend the last few minutes talking about different retirement accounts where you would invest inside of. So most of you are just starting your career, but we talked about what the target number is. For many of you, you're probably going to need around $4 million. And so if you're just getting started. And so it's really important to start now in paying attention in your retirement accounts. Treat it like your second job. Read your retirement plan documents. Some of you are dental residents that have already a retirement plan at the company that at the place that you're working at. Look at those documents. Understand what they are. Now, let's talk about what these different accounts are. You want to understand all the different tax advantage accounts available to you and how they work. And so we've got, if you got 401ks, you've got IRAs, and then you have benefit plans. Now, benefits were of the era of government workers or my parents. But for most people, pensions are gone. It used to be work for the government for 30 years, and then you're going to retire and you're going to earn 80% of your last salary for the rest of your life until you die. That's not the reality for my generation. That's not the reality for your generation anymore. And so that's why building that nest egg or finding some source of income that's going to pay you even after you work is really, really important. There are also backdoor Roth IRAs. I'll talk to you about what those are, health savings accounts, and 529s for college. So tax deferred retirement accounts, they're not tax free. What you're doing is you are taking money, pre-tax dollars before they've been taxed, and putting them into these accounts. And then these, so if you were to contribute into one of these, you are contributing it with money before it's taxed. It grows tax free. But then whenever you pull out of it, you're taxed on that, and it's treated like regular income. However, if you pay lower taxes and you accumulate more money, you can actually have higher returns in the long run. So it's a great, powerful tool. So first example is a 401k. And so you're getting pre-tax contributions. So your tax break is anywhere from what your regular tax bracket is, 28 to 37%. It grows tax free. I think this year, the maximum contribution that you can put is $20,500. The combination of, now a lot of times, remember, your employer will match a certain amount. That's free money. So at Atrium Health, for instance, if you're contributing up to 6%, the Atrium Health will contribute 50 cents of that, so up to 3%. So that's 3% of extra free money that you get. But the combination of what your employer and you can contribute is $57,000. The other thing is that it's protected. So if you were sued, the money that's in that 401k is actually not going to be liable. They can't go after that if you were to lose a case. That money has to be in there. You can withdraw from it, but you pay a 10% penalty plus the taxes on that amount that you pull out. But now at age 59 and a half, after that, you don't, if you were to withdraw out of it, you don't pay a 10% penalty, but you do pay taxes on what you withdraw. An IRA is another retirement account. Again, it's pre-tax dollars. And by the way, when you're talking about pre-tax dollars, it actually reduces your taxable income. And so if you earned 100,000 and you contributed 20,000, you're actually going to be only taxed on 80,000. So maximum contribution to an IRA is $6,000. It's tax protected, just like your 401k, and it's also protected if you were to be sued. A Roth IRA is powerful in a different way. You are contributing with money that's already been taxed, and then it grows. It grows tax-free, and when you pull it out in the future at the much bigger amount, it's also not taxed. And so, but you can only contribute if you're earning less than 208,000 if you're married and 140,000 if you're single. And the maximum contribution is only $6,000 a year. Now, the nice thing is that you can actually borrow against the Roth, or you can pull out your principal against the Roth without paying taxes. So let's say you contributed $10,000, it grew to 15,000. You can pull out $10,000 without being taxed. Let's say you need it for a down payment of a house. And so here's some things about traditional versus Roth and residency. What you want to do is contribute as much as you can to a Roth IRA when your income is low, while you're eligible to do that, so you can have a variety of money, different taxable money. So you'll be probably in a higher tax bracket closer to retirement, so you want to have both. I'm going to kind of go through this. I know we're kind of running low. I'll send you these slides. The last thing I want to do is just talk about, you can invest your IRA also into, and 401k into things outside of traditional stocks and bonds using a self-directed IRA. I have one of these. I invested in some of my real estate syndications in this. Health savings account, you can contribute up to $3,500 as an individual, $7,100 if you're a married couple. It actually grows tax-free. It's using pre-tax dollars, and you're actually withdrawing it tax-free also. And at age 65, you can also withdraw it without a penalty. So you want to have a diversified portfolio between asset classes, stocks, bonds, and real estate and alternatives. You want to be diversified within asset classes. You want to watch your costs, and you want to allocate based on risk, and you want to rebalance periodically. And you want to have less of the ones that are speculative and more of the ones that are more safe to give you that foundation. And the ultimate goal is to have enough assets that are going to pay for your expenses in retirement. And that's what retirement is. And so I'm going to give you a number of books to focus on. Again, I'll send these out on the email, but these are, if you're just starting out, these are great books to start with. Have a written financial plan in place. And so some take-home points, I'm going fast because I know I'm running over time. $1 million at retirement is really not a lot. Focus on the 4% rule. That's how they plan. The power of tax advantage accounts in terms of growing your portfolio faster. Stocks and bonds are great foundational investing vehicles, but they're not the only ones. Asset allocation is the most important factor. And try not to do things on your own. Just invest in index fund, have a plan, and then go ahead and live your life. All right. So I ran way over, but I'll probably have enough time for one question. You can always email anytime you want. Does anybody have any questions? Otherwise, I appreciate you for joining me tonight. I know I covered a lot of things. I'll make that calculator available. I'll have the slides available. I'll also, you can also look up all of these things on the books available. But without further ado, if we have no questions tonight, I will stop the recording. And thanks for joining me. Good luck and have a good night.